Are you ready to learn about Mike Zuzolo's new hedging mindset, his analysis on the higher, or I should say the lower corn yields in the United States, and yet why is he thinking that the wheat will have the best upside? Right here on Connected Farmer, your channel to keep you up to date with the latest trends in agriculture and livestock. Stay tuned and don't forget to subscribe. So, Mike, first I would like to learn your first reaction to last week's USDA report that was bringing significantly lower corn yields in the US, but not so low yields for soybeans.
Yeah, I think that's a really key point and distinction to start off this week with, Luis, from a standpoint that the corn number was essentially one of my final yield numbers. In other words, I was at a 174.9 yield, but I was expecting that to come in a couple months from now, not in the August report. But I understand where USDA is coming from because of while they do some farmer surveys, we also have a lot of satellite imagery that we rely upon for the August report. And that satellite imagery in some really key states was not showing very good vegetative growth compared to last year. And so not only were they high from a standpoint of putting it up near 180 for national yield in corn, they were high compared to last year's 172 final yield. So I think we had to get it down somehow closer to last year's numbers, and they did a really good job of that. But I think the really key number for me, other than the wheat coming back on as the leader to the upside and the leader to the market overall, was the issue of the soybean yield. And I think you rightfully point that out because if you think about the crop conditions in corn, both nationally and in the three primary states you and I have been talking about, Minnesota, South Dakota, and North Dakota, you think corn is bad, beans are every bit as bad. On a national level, we're sitting at 70, we were at 72%, I think, good to excellent last year at this time. And we came in this week at 57%. And when you look at the very poor conditions, which, as we've talked about, is much more indicative of the national yield, in my opinion. You're talking about 20.3 million planted acres of soybeans in those three states. So you're talking about 23, almost 25% of the total planted acres and a quarter of the soybean acreage base in the United States this year. And so these are three very big states that make up the national yield. But when you look at the very poor conditions, you're talking about Minnesota being at 28% and North Dakota being at 52% very poor conditions. That's both those states are 9 times worse than they were a year ago. And when you look at South Dakota, they're at 39% very poor conditions. That's 6 times worse than a year ago. So two things here. Yields can come down more in soybeans versus corn because of these conditions, because of what USDA did, in my opinion. And secondly, I'm really getting the point where in these three states, especially, it's not going to be very much help to get rains at this stage of the game with these very poor conditions looking very similar to where we were with spring wheat about a month ago.
Yes, and the macroeconomic conditions are added to your hedging analysis. Is that right?
Yeah, and this is the downside of the market. I can say today, roughly midweek, roughly a week away, a week out from the report, that we're no better off in price action, maybe a little bit better off in wheat, but we're really no better off right now than we were before the report came out, because in part of the macro conditions. And it really goes back to the Delta variant and especially this new kind of black swan issue of the geopolitics surrounding Afghanistan. I was fearful of the idea that the dollar would rally. We've talked a lot about that. That's still my number one issue with the market and the commodity funds. And this is where the funds versus the fundamentals come into play. The commodity funds, the investors, they're either going to be deflationary or inflationary. And if that dollar rallies, they're going to probably take that as a deflationary signal and get out of commodities. And that's what we saw as we got into the middle part of this week was the dollar started to rally. It got close to last week's highs. And all of a sudden, we turned into a risk off market, which included the stock market. And I think this has repercussions, especially in the equities markets. But we could talk about that later. But this is why, in part, why wheat is the leader in both the funds and the fundamentals. It's the leader in the fundamentals because of that really big drawdown in global supply that USDA gave us last week. Wheat's less of a competitor to corn now. The soft red wheat got up to $2 premium to the corn before starting to give way. And so it's really moving its mindset out of a feed grain back into a food grain. So that's the fundamental side and why it's a leader. Fund relationship and investment relationship wise, it's really the leader from a currency perspective. And when that dollar shot higher this week, you could almost bet the wheat longs were going to take profit. And boy, did they. And we went right up against the April and May highs in soft red wheat of about 773, 775. It's a really big area that we really got to get through to kind of re-bolster and reinvigorate the funds to come back in and buy into this market.
So, what is that relation you are seeing with stocks?
Yeah, I mean, the relationship I really want to point out is something we've heard and talked about before on our program, on your program, and that is the idea that while the cash price is higher, and it may look better on a revenue per acre basis to sell cash, the market is not rewarding these bullish supply fundamentals, and they're instead rewarding the bearish macro fundamentals. And that makes me think the funds will take the market lower. And if they do take it lower, I'd rather be in paper positions, i.e., bought puts, heading into September, because I think if we don't get a rally in August, like I thought we could on a bullish report, and I'm still hopeful we can, but if we can't get a bullish rally the second half of August on a bullish USDA report, and that's going to be because of the macro fundamentals, then we're probably going to have to wait till we go into delivery for the September contracts, because we still have, even though cash prices here in the United States are really falling rapidly this week in the corn, and one area of Peoria, Illinois, a river bid dropped 60 cents. I was told by a client in Indiana that a ethanol plant in Portland, Indiana, had dropped their bid over $1 a bushel just in 1 or 2 days. So the cash price is coming down, but the cash price is still about $1 higher than what the futures price is. So my thinking is protect yourself for the downside on the paper with the bought puts in case the funds want to press this market lower in the short term, but don't sell any cash with the idea that right before harvest or right after harvest, or maybe as early as the September delivery time period, we could have a recharge of this market.
Yes, and are you still seeing inflation pressure there?
We are, but I think it's inflation pressure, Luis, that's kind of, it's not leading inflation. It's kind of consistent or coincidental inflation. I just did some work on the meat side of the equation. And when you look at beef prices and we look at certain cuts of beef prices, we're looking at prices that are anywhere from 30 to 50% above year ago levels when it comes to certain cuts of beef, like 70 to 79% hamburger. That price is up to about 56% higher than year ago levels. When we look at bone-in ribeyes, we're at 29% higher than last year at this time. Boneless ribeyes are up over 50% versus last year's. They haven't changed much, but they're still elevated. And so I don't think we have any new inflationary pressures, but I think it's going to remain very elevated. And here again, this kind of puts a macro spin on what the Federal Reserve may do here in the next 2 weeks, because they're getting ready to go to that very important Jackson Hole, Wyoming meeting, that what they call the symposium, and a lot of big stuff usually comes out of that. So here again, it goes back to the dollar. If the bond yields are going higher and the stock market and the other assets are going lower because of safe haven buying. That's just going to give the dollar more upside potential, and that could trigger a sharp, relatively quick sell off in some of these commodities and agriculture, in my opinion. But demand remains very firm. We continue to see China buying soybeans. We saw South Korea's NOFI come in for corn this morning. So it seems as though our price is right and we don't have as much competition out there in the world for the row crops.
Yes, it's pretty interesting to hear from you what you know about the inflation in the agricultural sector. I saw a very interesting report saying that the demand during COVID times was highly unexpected for some products, and that forced some ships to return empty to China, and that had created logistical bottlenecks. What do you think is creating pressure for the agricultural products specifically?
Yeah, great question. I think number one is the transportation costs because of COVID. We still haven't been able to get the kinks in the supply chain worked out because we're still going into lockdowns and we're still masking up. We're still pulling back on restaurant demand. We're still pulling back on going back to school. We're still pulling back on the end of the summer grilling season because of the COVID, both here in the United States and over in China. And I think that's one of the biggest issues that I've been fearful of, is that China was slowing down. Well, their recent data and their industrial production numbers this week and their retail sales data came in with big misses compared to what the trade was thinking. Their retail sales data was 3% less than what the trade was thinking year over year. That was a big miss. It was about a third of the way off of what the number was. And so my biggest issue continues to be that the price of corn, beans, wheat, and beef and pork and poultry are going to remain elevated falsely because of COVID, because of either labor issues or because of demand issues that the supply chain just can't get smoothed out. And so therefore there's going to be added costs in the transportation, in the shipping, in the infrastructure of getting product, corn from point A to point B. And I think we're going to battle that all the way into the holidays and maybe even past. So that's why I've never really been an $8 corn bull at this point, Luis, because it's never been about demand for me. It's always been about the weather and the supply. And that's one of the big elements. So it's really a good question. It's a question that very few people have asked me. So my hat's off to you because it is a big piece of the puzzle.
All right, let's see what happens. Thank you, Mike.
Thanks, Luis. Have a great week.